We're here in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Ed Hochberg, who's head of Global Risk Solutions at Carpenter. Ed, welcome.
Thank you. Be here.
So, Ed, we're at or perhaps just past the peak of the hard market. What does history tell us about what that means for legacy market business?
Yeah, I think that we're at a bit of a crossroads in terms of the legacy market. There are a lot of reasons, as you said, with the end of the hard market, and history would say, well, now we're going to see some mergers and acquisitions. There's reason to think that we will see a pickup in activity, and I think that will be true to an extent. At the same time, we're still dealing with the soft market years in the legacy market, and what that means is that there are still some fairly wide bid-ask spreads in some of the U.S. casualty from those years. And so that's making it hard to get transactions done in some cases. And the market has also seen some contraction. We've lost some players in the legacy market. And while I think the demand is there, and I think there are certainly aspects along the lines of what you're saying in history would suggest that, I'm hoping that we see a bit more capital flowing into the space, maybe another player or two to help take up some of the demand for the product that I think is going to be coming down the pike over the next 12 to 18 months.
So that's an interesting point because that relies on investor appetite. Tell us a little bit about what you think of investor appetite for legacy business.
Well, if I had my magic 8-ball, it would say it looks cloudy right now.
Okay.
There's certainly reason to believe that we could see some increased investor appetite. We see some asset-intensive players trying to enter the space or entering the space, and I think that's good. At the same time, I think some of the bloom came off the rose as what we were seeing at the beginning of this decade when there was a lot of capital flowing in. We had some players exit. We had some results in some transactions that didn't go particularly well. And we saw some exits that maybe took the notion of these increased exit multiples off the table. And so I think investor appetite is a little bit cloudy. I'm not really sure what that's going to look like going forward. I'm optimistic that done well and in the right circumstances, it's a very good business. But I think it remains to be seen what type of capital we see flowing into the space over the course of the next year or two.
But the legacy business itself isn't the same as it was decades ago. What are the reasons for people putting business into runoff now?
Companies still put business into runoff for all sorts of reasons. The obvious ones are that you've had poor performance, but also sometimes this business never got to scale. And increasingly now in this environment, carriers have to think about whether they really have scale, whether they really have a competitive advantage in a particular line or class of business. And if they don't, they have to put their capital elsewhere. And once they make that decision, turning to the legacy is a great way to do it because otherwise that capital sits there supporting back year loss reserves and it's not doing them really any good. They're earning some risk-free return or something like that on the liabilities, and it's they probably have better uses of that capital. And so that's been the traditional role of the legacy market, and I think it will continue to take on that role as things shake out.
So we're here in Monte Carlo, and inevitably conversations will coalesce around particular topics. And one of the topics this year is AI. Do you have views on what opportunities, what challenges perhaps AI presents to the industry generally or the specific areas of the industry?
Well, AI did a really good job of planning my holidays, so I will say that's been really good. But look, I think AI is one of these topics that it holds a lot of promise for the industry. You could certainly see how it can improve decision-making, how it can improve underwriting claims, which claims to fight, which claims not to fight. Having AI by your side while you do that, you can see how the value in that type of exchange. Whether it's going to live up to the promise, I think that's a broader question for AI than just the insurance industry.
Great, that's a great answer. Thank you very much indeed. One final question, Ed, if I may. What issues are being missed now that will be most important in the future?
I think when we look at the future and when we look back on this time, I think we will look at how the distribution of the value chain really changed in insurance. And what I mean by that is that there has been sort of a redistribution of the value to both distribution, and not just distribution, but actually the brains of the insurance business. And when you look at how companies that trade at increased multiples, what they have in common with one another and how they differentiate themselves, it has to do with brains. It has to do with really creating that sort of differentiation and having a competitive advantage in something that no one else does. And that's where, and they're going to be capturing a disproportionate amount of the value chain going forward. And I think we will look back on the 2020s as the decade when that happened.
That is a fantastic answer. Thank you very much indeed. Ed, thank you very much indeed for joining us here in Monte Carlo.
It's been a pleasure. Thank you.
For AM Best TV, I'm Richard Banks.